This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Jess, welcome to the podcast.
Thank you for having me. I'm so excited to be here.
I am so excited to be here. It's been way too long.
Way too long.
We've spoken many times over the years, but I think this is your first time appearing on the Investors Podcast. I could be wrong about that. You've definitely appeared on our big channel, the Australian Finance Podcast. But today we're talking about ETFs, portfolio construction, and we're doing that through the lens of his and hers kind of portfolio. So you've got your portfolio that you're going to deliver, and you're going to say what it is, why you're allocating to these particular ETFs. I'm going to do the same, and then we can compare notes. Okay. But that will come up in just a moment. I want to start with a bit about you for people that haven't seen you on Instagram or online or read your stuff. You recently won an award for Investment Professional of the Year, which is a huge coup. So well done to you.
Thank you.
You're a CFA charter holder. You were previously at BetaShares and Macquarie. Pedigree, study, acumen, it's all there. Where did that come from? Like, where did the intense passion for finance and investing come from?
Yeah, so my origin story, essentially. Kind of like you mentioned, I would say I've always been a numbers girl. I've always gravitated towards maths or finance subjects in school. But my very first memory of investing, and you might have heard it before, I've mentioned it elsewhere, but it actually goes back all the way to year 3. And that was when my teacher... Now this is where I show my age, but my teacher gave the whole class a photocopy of the stocks page. So that's when in the newspaper at the end, it listed all the stocks on the ASX and their closing price. And the task, which is actually very similar to our challenge today, was you have $10,000 pretend money, and then you need to build a portfolio of stocks. So that was my very first chance or my first interaction with investing, and it came. So then the task was we would check in weekly, check the performance of our funds, and not to brag, but my portfolio did do the rest. So I think that whole exercise really planted the seed in me, and it was really, I guess, eye-opening and really interesting just to put the numbers and what it means, like putting numbers and finance into real world. And so then... and what's funny about that is essentially you can say I started as an active portfolio manager since I was in year 3, and now I've ended up on the ETF side of the world. But what's funny was that essentially I started my career in year 3 as a stock picker, as an active portfolio manager, and now I found my home in ETFs. So back in year 3, I was picking stocks, but today what I get to do is something much more interesting and I'm much more passionate about, and it's to give investors so much more, and it's something that's so much more powerful, and that's what we're talking about today, ETFs. And for me also the why has grown as well. So I want to help people feel confident with money and investing, and especially those who haven't typically or historically seen representations of themselves in the industry. So good. I'm going to go out on a limb here and say you're the only ETF portfolio manager ever to appear on this podcast. So that is a huge thing, really, when you think about it. Like, we have a lot of investment specialists, a lot of active portfolio managers, CIOs, that sort of stuff, but no one ever that's been a portfolio manager for ETFs. So I wanted to ask you, what does an ETF portfolio manager do? So I was joking that I started out my career as a stock picker in year 3, but I actually did start my career on the active side of town, not a fundamental stock picker, but more on the quant side of things. So that was when I was at Macquarie. We looked after systematic equity funds. And surprisingly, my day-to-day now, when I was in a quant team versus now as an ETF portfolio manager, is not too different. But what I think is a key difference between, let's say, an active high conviction stock picker and an index PM is that essentially I'm a risk manager. I'm not a stock picker. So my job is to minimize tracking error. So that's the difference in the daily returns between the fund and the index, and deliver returns to the investor that best track the returns of the index. So my job is not to generate alpha. It's the products that we create that generate alpha. And my job is to manage risk and exposure and people's money.
So you would be looking at like trades coming in and out of the portfolio? Do you deal with like market makers and that sort of stuff on the other side?
Yeah, so a typical day involves, like you said, we have to trade for flows or money coming in and out of the fund. We also have to deal with corporate actions and index rebalances, as well as monitoring cash and currency exposures. So I guess the analogy that I like to make, so if you're an active PM, you're essentially the one that's going to design the plane. You're also creating the flight path, and then you're flying it as the pilot. But then as an index PM, we run a whole fleet of planes. For each PM that we have on the desk, we look at least after a dozen portfolios each, of which each portfolio could have between hundreds to thousands of stock. So I don't have the luxury or the time to look into each one into detail. So that's why I go back to my job, or I see the mindset of my job is really risk management at its core. And then what I have to do is put in guardrails in place so that the fund tracks the index. So our role is more like, have you ever played that game, the air traffic controller game? Yeah. So like my role is more of an air traffic controller. So we have to make sure all the planes, all our portfolios throughout the day with everything that's happening, corporate action, market movements, flows, are staying on their route so that all the planes can arrive safely at the destination.
Oh, wow. Cool. Cool. And do you enjoy it?
Yeah. And I think what really sets, or what's different about the ETF is that you're a part of something so much bigger. And that is the whole ETF ecosystem, as what you've touched on before. And I personally, if it hasn't come across already, I'm very passionate and I love ETFs because I feel like they fundamentally changed the investing landscape for everyone. It's democratized investing. It's allowed access and allowed, everyday people, yourselves, your parents, your friends and family to access markets and then thus create more transparent, diversified and cost-effective options. Like thinking back to when I was in year 3, ETFs didn't exist. I mean, my portfolio did very good, but I just invested in stocks that I was familiar with. Like, we bank with ANZ. I have a Dolomite account with CBA. So, that I would assume that logic of investing is not too dissimilar to how most people do it now. But the fact that ETFs is just another way for you to access all of this and so much more is such a great tool. So every day we collaborate across the whole ecosystem. So that means I'm frequently in contact with market makers, ensuring a seamless experience and also the best outcome possible for investors as they invest on our ETFs in the secondary market. And that also includes working with exchanges on a daily basis, make sure that our products are within guidelines as well. And then also closely working with index providers and research house to innovate new products. So I think ETF is very synonymous with the word innovation. We're always changing the way we're doing things. We're changing the exposures that we're giving to investors. And of course, lastly, we work with investors who are using these tools to reach their goals. And like speaking on platforms like yours. Like I said previously, my role isn't necessarily about generating alpha through stock picking. It's the products that we create do. It's about delivering. So my role is really delivering about precision, risk management and execution, and to do that over and over and over again so that we consistently deliver index returns for our investors. And ultimately, the much bigger part of that is that we're building products that empower people to build their wealth and their financial independence. And I think that's a real impact. And what I guess is the thing that excites me the most about working in ETFs is that we're not just running our portfolios. That's actually just a small part of what we do every single day. We're helping shape the industry as a whole. So now the ETF landscape in Australia is close to $300 billion in assets under management, and we're hitting new records every single month. So it may look different. So my role as an ETF portfolio manager may look different to the traditional image of your stock picker or your active portfolio manager, but the outcome is the same. If not, if I dare say, in my opinion, if not even bigger, right? So we are giving people access, confidence, and the tools to achieve their financial future. And that's what I love about it.
I love how you put it, because effectively you put the power to make active decisions back in the hands of the investors. Because you say, we build these things for you to use in your portfolio. So I think that's a common misconception, is that when you invest in index funds or thematic funds or anything that's like rules-based, you think that it's purely passive, but it's actually not, because you're making an active decision on what you allocate to each and every day, right?
Exactly.
So you're the one behind the scenes that if someone does pick a particular fund, you make sure that it delivers exactly what that investor has intended it to do in their portfolio, which is really, really cool. So, and kudos to you because you straddle the technical really well, but you also articulate the process and the bigger picture of how this impacts people's lives so well. And I think that's a real credit to you, Jess, because I don't know any PMs in ETF world that are capable of that. Like maybe I haven't met them, but I just don't know anyone. So real kudos to you.
Well, thank you. And to that, I would say, historically PMs, and like I mentioned before, we're numbers people. But then as to why I'm so passionate and to why I kind of force myself, so I would classify myself as an introvert, but then I kind of force myself into these positions really mainly for the representation, because like I mentioned before, growing up, ETFs didn't exist, or even in the typical finance space, you don't see females or you don't see younger females, especially in this space. So that's why I think it's really important to be the representation. For sure.
And you're nailing it. I was chatting to the team about that the other day. It's like you can't really imagine it until you see it, right?
Yes.
And that's, I'm sure you're inspiring lots of young women in particular to do it, but also older women as well who want to try their hand as well. So no, full respect for what you're doing. Now, my challenge to you, I'm going to put on my glasses because I'm getting old. And
I'm putting my glasses on too because this is getting serious.
Okay, so isn't that funny? We're two oldies here on the podcast. We're going to talk about this $100,000 challenge. So I put a challenge to you, and the challenge is that we have to deploy 100,000 fake dollars into a portfolio, but you can only use Global X ETFs, okay? And then listeners and viewers can follow along, and we'll make these all available. We'll put a link in the show notes to a blog post that outlines the allocations and the particular ETFs. I gave you the rules of the game. So we each start with 100,000 Rask dollars to allocate to a portfolio today. Now, rule number one is it must be fully deployed on day one, so we'll take today's prices. Mm-hmm. The goal is performance over 10 years. And I kept that kind of broad. It's like performance, whatever that means to you. Number three, we can only use Global X ETFs. That's pretty obvious. Mm-hmm. And number four, we must have a minimum of 3 positions and no more than 10. Because I didn't want you to come in and be like, I'm just going to pick one. I'm just going to pick FANG and see what happens, I wanted to kind of flesh out the insights from you. And number five, we can weight these ETFs however we want. So I've got my list. You've got your list. Mm-hmm. How do you want to deal with this? Do you want to go first?
I think you go first.
Okay, cool. Do you want me to run through everything, or do you want me to go one at a time?
Let's do one at a time because our list definitely has similarities. So maybe we can kind of do one each, and then when we start to diverge, I think that's when the real conversation starts.
Okay, cool. Now you've got in your portfolio, I'll start with mine. I'm going to start at the very top with A300. Mm-hmm. I've given this a 30% allocation. A300, broad-based, top 300 Aussie shares. You get the yield, you get the compounding, but it's super low fee from memory. 0.04. I think it's a great ETF. And the fact that I always like the 300 over the 200, everyone has their preferences, I guess. But my preference is that it gets you more of that kind of mid-cap, small cap.
Yeah, mid and small.
Even though it's not a huge allocation, you still get that. So that's A300 for 30% in my portfolio. Now over to you.
I actually have exactly the same, A300, for very similar reasons. So I have A300 at 30% as well. Main reason, yes, the 300 and that it's a low fee. It's one of the lowest fees for the exposure on the Australian ETF market. And it just gives you great diversification, and especially and you can tell later when we go through the rest of the portfolio, it'll give you not only that home bias, but then also the financials and the materials, which I guess is more lacking in the other ETFs that we've chosen.
Yep. Cool. Now, my second biggest position is a divergence from your equal biggest position. Mm-hmm. So my second biggest position is U100. And this is an ETF that charges 0.18% in management fee. So in my notes, I put, it's concentrated enough for some talk. What a phrase for investing in ETFs. But basically, so a lot of people are familiar with the S&P 500 or even familiar with the NASDAQ 100. This ETF kind of combines all American companies. Mm-hmm. And again, top 100 companies focused on innovation. You get all the names that you'd expect in there. So some of the FANG names, some of the non-FANG names. Mm-hmm. And I think broadly speaking, low cost, lots of exposure to the world's kind of leading innovative country, which is the United States. Really happy with this position at 20% of the portfolio. So that's number 2 for me. Yeah.
So my second one is our GARP ETF. So that has a management fee of 30 basis points, and my allocation to that was 30%. So I guess the rationale on how I came to choose my portfolio is I'm quite lazy. And, and so I believe in how can you do the most with the least amount of effort.
Yep.
So that's why, because it gives you global exposure, so global developed market exposure, so just going beyond US because we have more US exposure to come, but then also it's giving you that growth and that value. So GARP gives you growth leaders at valuations backed by strong balance sheets. So essentially it's the stocks you want to own. And then with what's going on in the US, which we'll touch on later when we go on to our next allocation, everything US exceptionalism definitely still exists, but I think there are other reasons as to why you want to diversify across regions and whatnot. So that's where I think GARP comes in.
Okay, I like that. If you took it on the 10-year view, right? Does the at a reasonable price hold you back? So if you're saying from here to year 10, do you think that by not holding those overpriced stocks, so to speak, does that hold you back?
So I think this comes to the beauty of the index methodology and the fact that it's a rules-based fund. So that whatever we feel as relative price or price, well, now that will consistently change. And with the index rules going through the list every single time and coming with the constituents, it makes sure that the names are relevant to that point in time. Okay,
I like it. So maybe I'll go with then one of my US positions again, which is FANG Hedged, FHNQ. Now you may be a bit surprised by this one. Why FANG Hedged and not FANG Plus and just in US dollars?
Yeah,
is because I believe the FANG ETF represents kind of like 10 of the best companies in the world. You got all the big Mag 7, Broadcom, so many other brilliant businesses in there. Now with this in particular, wait, I just want to make sure Broadcom is in there, isn't it?
Yes.
Yeah, cool. I just want to make sure because I flipped on that one. Okay, cool. So you got all these amazing companies in there. But I also think that the currency of Australia, I don't have as much conviction over the currency right now where we are today at the time of recording. But I don't think that matters. I don't think I need US dollar uplift. I think in a portfolio where companies are growing so fast and so consistently, what I wanted to isolate in this portfolio at least was the purity of the earnings per share growth over the next 10 years. So capturing that movement to the cloud, capturing that movement in AI.
Yes.
I think that's enough to drive this portfolio for the next 10 years.
Oh, interesting.
So cut out the currency movement and just focus on the actual underlying. That was my view.
Because now after I've seen all your portfolios and the listeners will understand once we go through the list, I did have a question to ask you.
Yeah,
You've definitely got a lot of currency hedge products in there. So why are you so anti-US dollar, it seems like? Because I've got a currency hedge exposure too, but I've decided to play out my hedge in a different way. But yeah, you definitely have a lot of currency hedge exposure.
I guess the reason is a few reasons, but I think that what we've seen compression of the US dollar, Australian dollar, sorry, I should say, is the Australian dollar has fallen. It's at a long-term range where I think it's slightly below fair value.
Yeah.
And I know that's a really blah thing to say because there's no one that knows for sure. We can use interest rate parity or something like that to try and determine it. But really no one knows currency at the end of the day, in my opinion.
Yeah.
So I think that I choose the US dollar as a safe haven for when there's a lot of when there's a lot of volatility.
Yeah.
And we see that in major corrections, GFC, COVID crash. The US dollar, there's flight to that currency. So I don't think that where it is now, it should reasonably go back below 50 cents or below. So I think the upside from having that cushion isn't there anymore. I think that it's probably equal parts risk and equal parts benefit. So for example, if we saw a crash, would I see the currency falling below 50 cents? No.
Probably not, no.
Would I see it going above 90 cents? Maybe, but unlikely. So I think we're kind of in that fair range. So I'm happy to take a hedge position in this instance. That's my kind of back of the envelope logic.
Because I definitely share a similar view to you in the sense that given at this point in time and the regime we are at, Trump definitely wants a lower US dollar. Now the main concern is the twin deficit concerns and whatnot.
Yeah.
So that's why I do have a currency hedge exposure, but I actually choose to express it in the form of currency hedge gold. So
GHLD.
Yeah, so I'm jumping ahead a bit here, but I have 8% at GHLD. And then now I'm jumping forward again because you mentioned what happens to try to capture the potential upside if the US dollar does go above 90. For me, that's actually why I chose to just have FANG, just the FANG Plus at 10%. So I do have my currency hedge exposure via GHLD, via the gold in the GHLD and some other exposures that we'll touch on later. But if there is potential upside in the USD, FANG will also capture it as well. That's the reason why I did what I did.
True. I like it. Now, I actually realized there was a mistake in the notes that I sent to you.
Yeah, you cheated.
Yeah, I actually doubled up on the next position, which was Dragon.
Oh, you did.
But what that was meant to be was I was meant to agree with you and have unhedged gold as well. So I wanted GHLD and GXLD. So for people that are playing along, there's two Global X ETFs that target physical gold. One is hedged, one is unhedged. GHLD is hedged. And so my approach was going to be there, hedged and unhedged gold. So 5% in each. And the reason is pretty simple, that I think that gold is a great insulator of returns, but it's also proven that it's a very good, over time, it's proven that it's quite, how do I put this, resilient.
Yeah.
Through economic cycles. It's time and time again, it's proved me wrong. So even though this is effectively an all growth portfolio for me, that's a great backstop. So I'm choosing half and half, which
that makes sense.
I don't know if you know this, Jess, you probably do, let's be honest. But a lot of financial advisors just do that. They just go half and half, hedged, unhedged, which is fine.
Well, I mean, a big reason why we developed these currency hedge products is as more of a tactical tilt. So then if you wanted to express views, that's what they were used for. So yeah.
Cool. Okay, what's next for you?
I have GXAI next.
Yeah, this is different. I did not have this on my list. Talk me through this.
So I definitely am a firm believer. I mean, we see it now that AI is here to stay. It's not necessarily a bubble in my perspective, but then I see it as a mega force. It's fundamentally changing the way we live, the way we work, and all sorts of things. So for me, I see this as a mega force that's here to stay. So we already have GARP, which has around 60-70% US exposure, and then I topped it up with FANG, which is already kind of your AI mega cap names. But then what I also think, and what I kind of touched on before, is that we are seeing in terms of the US market, it's broadening out, right? So in terms of performance, it's kind of starting to run away from these top names. But then we're still so early in the AI adoption phase. So yes, we have ChatGPT and whatnot, but we actually haven't gone into the monetization phase, or how we haven't seen it drip into the economy in terms of GDP growth. Like, for example, going back to a previous thematic in like social media or gaming, when that whole segment really got monetized in terms of like killer apps, like, do you remember Candy Crush? When they really monetized it, that's when everything kicked off. And then putting that into comparison now, we're still not really there yet. In GX, in terms of AI adoption. So that's why I think we're still early phases. So that is why I've actually given a 10% allocation to GXAI, so that when we go to that broader adoption, because it does give you exposure to the whole AI value chain and the pricing power, and that's when we will see the real productivity lift. That's when I think GXAI will really benefit from that.
I brought up the page now. At the time of recording, it's done 32% in 1 year. I did not know that.
Yeah.
Wow. Biggest holding at the time of recording, Tencent. Third largest, Samsung. Cool.
So this one is very diversified across countries, across sectors. It's across hardware, software. So this one is the purest AI play, we believe, on the market. And then it's also diversified. All the stocks are capped at 3%. So it gives you a well-rounded exposure to the whole AI thematic as a whole.
Question for you. A lot of people ask this question. Why in portfolios are holdings typically capped?
So then there is this thing where a market cap weighting. So market cap weighting is we just do the size of the shares outstanding times last price. That is the market cap of a company. And let's just say if there was a market cap that was 90 million of one stock and stock B was 10, and market cap weighting would mean that the weight will be 90 and 10. So what you kind of don't want to do, or why we sometimes diverge away from that, is that momentum, or if the winners keep winning, then you kind of just have all this concentrated exposure like what we have in the S&P 500 and the NASDAQ now. So that's why there's more products that are equal weighted now, or that's why we've also launched Russell to give you that smaller cap exposure. So it's more for the case that if you want to broaden out your exposure, or if you don't believe that the winners will continue winning, that's when the stock cap comes in.
I wanted to talk next about Dragon. So Dragon is the Chinese technology ETF. Now, it's in your list as well as mine. But this has grown on me through time. When it launched not too long ago, actually now, Billy made a really convincing case for why this should be launching now and why it's included in portfolios. And for such a long time in emerging markets, I don't like to call China emerging markets. It's clearly not. It's the second biggest economy in the world. But that's how we categorize it as an investment ecosystem,
The
I
rules
guess.
are the rules.
Yeah. And a lot of the times with emerging markets, what I've found, Jess, is that when you have a simple index methodology, just a pure index methodology, you don't always end up with the exposure that you want. We'll talk about that when I talk about India in a sec. But I like to err on the side of quality companies in those markets. So companies with good sustainable profits and those types of things. But what we're seeing is that, and as Billy has made the case on the show recently, like the A shares and the H shares are really giving a new lease of life to the Chinese market for foreign investors. And what you can do with Dragon is effectively get exposure to the world leaders in relevant fields. BYD is a good example. Cattle is another one for batteries. So these businesses, absolutely wonderful businesses, and available through China Tech ETF Dragon. I'll give it a 10% weighting, which is probably pretty high. But one of the rules of the game is you have to win over 10 years. So I think that this might actually be a real interesting business over ETF over 10 years, and the businesses inside them will benefit from Chinese policy.
I strongly agree. I have Dragon, like you mentioned, in my portfolio too, and I have it at 8%.
8%?
Yeah, so very similar. So for me, I kind of see this as the best of both worlds. The tech, the innovation, and China is at the forefront of that. And then further to my point in diversifying away from US exceptionalism. So that's why then you have some of the China exposure as well. And then going back, so this one, I was so excited about this product. This is a product that Billy and the team, we've worked really closely with the index provider that we actually created from scratch. So this is a perfect example of how, we get to create something and then just seeing like people like you really like gravitate towards it and think that it's a great idea. It's just great to see and great feedback.
No, I really, really appreciate this. Now, you've got one more that you want to go to, and then we'll kind of summarize your portfolio in a sec. So maybe I'll just go with a couple of mine real quick. So at a 10% position, it's an ETF that I, in real life, was going to allocate to for our portfolios, which is OZXX, which is the Australia X Resources X banks or financials. So this is an ETF that I first learned about because there was some clients that Global X have in Perth that have a lot of clients, like financial advisors, had their clients in a lot of bank shares and a lot of mining shares. And they were like, well, can you build an ETF that's everything but that? And I thought this was not just as it's originally intended, but actually the ETF itself provides really good exposure because it effectively diversifies away from the banks and miners. You end up with a lot of industrial companies, which is probably what Australia is not always known for at the blue chip end. So it really gets good exposure to that. And a good example of this for people playing along at home is the biggest company inside this ETF at the time of recording is Wesfarmers, which owns Bunnings. So I think that it provides really good pure exposure to a more industrialized version of the stock market. And you get tech names, you get so many other good businesses in there. So probably not as it was originally intended, but I think it's a good addition to sit alongside A300.
I can see that.
Yeah. The other one, which maybe I'll quickly jump to, is the India Nifty 50 ETF. I feel like I'm a bit of a cowboy today on the show, but basically similar reasons to China, probably a little bit different. Some great companies in India, businesses like Reliance Industries, for people that aren't familiar, it's a wonderful conglomerate business. Wonderful technology companies, huge population, obviously probably the biggest quote-unquote democracy in the world, and really a business that is opening up to foreign investment. I keep saying business, a country that's opening up to foreign investment. there was like 5 or 10 years ago where a lot of foreign investors couldn't access the Indian market and needed special licenses, or you needed to be a citizen or something like this. But nowadays, access is there, and the market's quite narrow, which is one of the criticisms of the Indian market. But I think as a 5% position in my portfolio, there'll be periods where there's drawdowns, but hopefully over the long term, those businesses begin to thrive. And I think a really good example of how far India has come with technology is the fact that they're launching into space and landing on the moon.
Exactly. It's definitely the growth story of India.
Yeah. And I just think that's remarkable. Like a lot of people probably don't realize that. Partnering with NASA and other, massive international or global organizations on the technology side, India's definitely proven its chops. And I think it's a market that people probably want some exposure to.
I can definitely see that, yeah.
Now, I've got 2 final small positions, but your position's bigger than mine, so why don't you go first?
So my last one is Bitcoin, so our Bitcoin ETF, ticker EBTC, and I've just allocated 4% to make the numbers add up to 100.
Okay.
So my approach overall is kind of my core, so that will be A300, GARP, and FANG as a core enhancer, and then my tech or my AI exposure, so that's through GXI, Dragon, and then my commodities or my hedge, so that would be my hedge gold and Bitcoin. So that's why I've allocated a small portion to Bitcoin.
Yeah, I like it. Do you own Bitcoin personally?
I do.
Yeah?
Yeah.
How long have you held it for?
A long time, but I invested very little. So like it's done very, very well. But always in hindsight, if only I had put like $10,000 as opposed to a couple hundred, then it'll be a completely different story.
Yeah, for sure. But it has been a wonderful thing for people that have held it for a while. I did actually put a little bit of money in, but as well established on the podcast, I actually forgot my secret phrase. To get into my wallet. So that's long gone, along with all of the NFTs. So I bought some stupid things. But one of the things that I also did was mint some NFTs, including, you know what I did,
I remember
Jess?
that.
I minted NFTs of my own photo.
I was going to say, don't tell me you did one of yourself.
I did an NFT of myself. And the reason why is because at Twitter at the time, they had some harebrained ideas. And one of them was that you could link your OpenSea account to your Twitter. And you're like, why the heck is he doing this? Well, because at the time there was heaps of impersonators that were trying to scam some of my followers, and I couldn't get a proper verified account because at the time you had to be like a politician or a journalist.
Yes.
So what's the easiest way to get verified? On the blockchain.
Okay.
So then I linked my blockchain account through OpenSea to my Twitter, so but it was basically impossible to impersonate me. And so for that reason alone, I started minting NFTs and doing all those types of things. So
how many pictures of yourself did you mint?
3, and the Rask logos as well. So no one could duplicate the Rask logos. But here's a key thing for anyone that's on the blockchain. Just don't forget your passwords. Keep a copy. So I can't lay claim to having it in my portfolio because technically I don't have any control over it whatsoever. But I even put this to our investment committee recently of having something like EBTC in our portfolios, even as a very small allocation of like 1%, just to have the exposure there. I think that, we've come a long way. I was very negative on it earlier on. Still kind of am writ large, but I think it's an interesting one. So I've got it as 2.5%, Jess. My final position is the Global Tech ETF. So this is the Morningstar Global Technology ETF. And this is similar vein to what you were talking about before with GXAI, but less probably specific. One of the things is that it actually blends really well, I find, with U100. You don't get the huge concentration in some of the holdings. So here's an example of the top holdings as of the 25th of August, 2025. Monolithic Power, Block, Vontier Corp, TDK Corp, WiseTech, Microsoft, Sony, Infineon, Marvell Technologies, and Dynatrace. So these are companies that, 8 out of 10 of them people probably never even heard of. And it's a real interesting business. So just reading from the Global X website here, software as a service, platform as a service, infrastructure as a service. So a lot of those SaaS companies are in here, edge and cloud computing infrastructure. So it's a different way to play the broad theme that you were talking about, less specific, but global business diversifies well. Businesses that you just wouldn't see represented necessarily in U100, at least not in the top, say, 30. So it's a small position at 2.5%. But I'll come back to your portfolio in just a second. For the whole portfolio, using just Global X ETFs, including some slightly more expensive ones based on the fee load, this whole portfolio blends to around about 0.24%. So if people are thinking like you're analyzing your super fund and what you're getting from that, a lot of the big super funds are way more than that.
Yeah.
So you can build a really robust ETF portfolio using only Global X ETFs. So that is really cool. Now, why did you say before that you like simplicity?
Because, and if you follow my profile, you would know my whole, I guess, the logic or what the message that I want to spread is that everyone can invest. You don't need to overcomplicate it. The most important thing is just to get started. So that's why my approach has always been more of what's the most accessible and the most replicable for you to be consistently investing, because that's the hardest part, is to be consistent. So that's why in my mind, I've kind of simplified it down to the least barriers of entry as possible. So that's why I've tried to do the most with the least. And yeah, to your portfolio, the only slight criticism I would say is that given we are at 100 grand or 100 Rask dollars, you definitely do have a lot of positions. Yes. And I guess from a portfolio management perspective, even the rebalancing costs, the trading cost of entry, that's all something to factor in as well. So that's why I'm all for doing the most with the least.
I like it. Now, my rebuttal, ma'am, would be that the brokerage costs have come down so far now in Australia. And if I find out in year 3 or 4 that China Tech's not performing as well, but maybe there's a new Global X ETF that does something similar, I can switch. And so I think
you didn't make that in the rules, so no, you're not allowed to switch.
Yeah, well, that's true too. But I think that I kind of find this sweet spot, and you're right in it, by the way, of what you got there, 7 ETFs, that's probably a good mix for people that want to be, like you said, kind of simple, but also want to have some flexibility. I find when you go with really narrow ETF portfolios, it can work as you're building your portfolio up and you're building that base. But as people transition through life stages, I find the extra flexibility of having a few more positions really does start to pay off for them. There's less tax bills to pay. They can be a bit more dynamic with their portfolios. They can switch from accumulation to income or something like that a bit more easily. So you're probably right. I've got a few too many positions, but it was pretty hard to choose from all the ETFs.
That is true. And I can definitely see what you're doing in terms of the core satellite and what you're trying to do with India and Dragon and all those exposures.
Yeah, cool. Well, I appreciate that. And I like the simplicity of yours. I did not expect you to pick GXAI. That's the one that definitely caught me off guard. But GARP, that has performed incredibly well. So I can see why you did that. And you answered my one concern, which was that like about the valuation, and you kind of touched on that it's about bias as well, right? Like I could be biased in saying that, hey, are you worried about this or that? But you're like, well, this way you got a rules-based approach. Yeah. Now I've got one final question for you. But before we get to that, you've got an Instagram. Where can people find you on Instagram?
So you can find me on Instagram, TikTok, and YouTube. So my handle is Theleungway. So TheLeungway.
Cool. I'll put a link in the podcast player to all of that. You're also, on LinkedIn. People can connect with you in multiple ways. You speak at events. You do podcasts like this. So there's plenty of good material. And of course, you're here at Global X. So hopefully we get to hear more from you in the future, Jess. I'd be delighted. Now, my final question that I ask all people that are new on this channel, which is the Investors Podcast, is if you could go back in time and tell yourself one thing about finance, business, life, investing, whatever it might be, what would you tell a younger Jess?
So let's stick with investing and ETFs, because that's kind of the topic of today. What I would say and what I often say to my followers is that you don't need to be perfect. You just need to get started. And the main reason behind that is, there is no perfect strategy. There is no one size fits all approach. Everyone has different goals. Everyone has different risk profiles. And even with returns, you might be able to pick a stock that 10x, but I can always find you another stock that did even better that you've just never heard of, or another crypto or another thematic that outperforms even more. So chasing perfection is often what holds so many people back. But if you just started and to be consistent, that's all that matters. And so what matters the most is building the habit, taking that first step and just learning and having fun. And that's part of the journey because, at the end of the day, in my eyes, investing isn't just about money. It's about confidence. It's about independence. It's about financial freedom. So if I had known what I know now, I definitely would have started earlier, but not just to grow the wealth, but just to grow the confidence that in terms of what I'm capable of, and that investing is very accessible. Everyone can do it. And that's where I share my journey today so that others can see it and believe it too.
Cool. I think it's wonderful. inspirational, Jess. So thanks for that. I think, you're spot on. You get confidence from doing, right? And that's a big one because your perfection can be the enemy of progress.
Yeah.
So that's a big one for me. And I really appreciate you taking some time to share that with me and to share that with the community, and as well as your portfolio. It'll all be up online. And we'd love to know what people think. So get in contact with us. If you want us to do it again, and have a bit of a tilt next time, a bit of a theme, we can do that.
We need
too.
to do like a check-in or a checkpoint.
Yes.
Oh yeah, is there a prize? This has to be a prize, right? No.
Well, maybe the winner gets $100,000 Rask in 10 years. So you can hold me to that. You can look me up.
You should mint something now.
Yeah, that's it. Yeah, we'll mint a new portfolio. We'll get in Bitcoin now.
Yeah.
But I don't know. We'll think about a prize. But let's check in. We can start tracking these portfolios and see how we go. But I've got a feeling now that I think about it, you're probably going to win. So I'm a bit intimidated. But Jess, this has been heaps of fun. So thanks for joining me.
Thank you for having me. I've had so much fun.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.